we are in the run-up to Diwali. We are going to get you top Diwali ideas from key brokerage houses. We start off with HDFC Securities. Joining us today to discuss their ideas is Deepak Jasani, the head of retail research at HDFC Securities. Deepak, good having you. Thanks so much for joining in. Let's start off with the first one, and that is Apollo Hospitals. I believe the call that you're giving to your clients, and indeed everybody else, all our viewers as well, is that people can buy and add on declines. Can you explain the rationale here?
Yeah, good afternoon. The rationale behind Apollo Hospitals, basically, it's a well-known company, one of the premier healthcare companies in the country. The company has undergone a lot of underperforming 3 years, the period where it had done a lot of capex in its pharmacy business, in its hospital business. So as a result of which it suffered in terms of the top line, the profitability, and also the return ratios. Now, I think that period of investment is coming to an end. The pharmacy business has started to do well. It is constituting 40% of the revenues, and it's growing at 24% CAGR. It has turned EBITDA positive. The hospital business also now will inch up in terms of occupancy ratios and in contribution to the revenue and the profit. And so overall, I think having regard to the fact that the stock has not performed so far, but has all the things in place for a good performance going ahead, we thought this is a good pick. And typically in all our picks, we sort of advise that the investors should buy some quantity at the current price. And in case the stock price falls to a particular band, then they should add in that band. And then hold on for expecting the target to be met over the time horizon that we have mentioned.
Okay. The next one is Cummins India. And it's a stock that has been in focus the last 2 or 3 sessions, some long positions out there. The results have been strong. Are you comfortable, Deepak, to tell your clients to go out and add a Cummins India or buy a Cummins India at current levels as well? And again, do explain the rationale for Cummins.
First, let me clarify that the results of Cummins have come out after the issue of our reports. So when we issued the report, the stock price was 676. Now, of course, it has moved up post the results. Now, Cummins, as a lot of us know, is a 51% subsidiary of Cummins of USA, leading manufacturer of diesel engines used in generators in India, having 8 manufacturing facilities in Maharashtra and Gujarat. Now, the introduction of newer solutions catering to the demand from mining, industrial, railways, etc., will lead to good revenue visibility for the company. The exports from the company are going up due to support from the parent. The domestic business also continues to do well. As a matter of fact, in the latest quarterly numbers, the sales growth came in at 30% for the whole company. And the sales, the absolute number was the highest ever quarterly numbers for the company. Now, this is split up into 34% growth for domestic and 21% for exports. So both the businesses continue to do well. As a matter of fact, the company has revised the guidance upwards today itself. So I think if one is banking at an industrial and infrastructure revival in the country, Cummins is one of the best places to be in.
Okay, the next one is Dr. Reddys that you like, and you have a target price of 29.52 on the counter. What's the rationale for liking Dr. Reddys?
Now again, Dr. Reddys, the results came out after we issued the report. So when we issued the report, the price was at about 2,532. Of course, there was a negative news also post the results in terms of Form 483 being issued in terms of for the Vizag plant with 8 observations. So basically, Dr. Reddys again is a quite well-known company. It is a vertically integrated pharmaceutical formulation manufacturer, diversified manufacturing footprint across many countries, 42% of the sales coming from US, a lot of ANDAs and new products to be launched abroad as well as in India. India's market share, they are trying to bring it up from 10% to 16% over the next 1 or 2 years. It has also done a lot of cost rationalization in terms of streamlining its cost, selling 2 of its units or businesses in the past 1 month. So basically, the company is aware of what it needs to do post the past few years, where the whole sector has undergone some sort of a derating due to the FDA-related issues and the continuous fall in the generic price. So now I think things are falling in place for the company, and even the Chinese market is now being opened up, and Dr. Reddy's is one of the first movers to get into that country and take the benefits out of it. So that is the rationale behind Dr. Reddy's.
I just have one query on Dr. Reddy's. If you saw the numbers, the US markets didn't do well. It came in almost $20 million lower than what was anticipated. In the management conference call, they said that they don't have any clarity on Suboxone because that is under litigation, and for Copaxone as well as Nuvaring, the launch probably will be in the next fiscal. So probably till FY20, there are no major launches that Dr. Reddy's has. So are you sure that they will be able to? So how do you see the US markets growing up, because that's the key market for them?
Yeah, the management has earlier said that FY19 will be a challenging year, but so far in their HY numbers, there doesn't seem to be too much challenge in terms of the growth in the bottom line, at least, if not in the top line. So I think the management is being a little conservative, trying to bring down expectations, and in the past they have sort of done better than expected in most quarters. So I think we will try to keep that hope, and based on that, we think the company may do well and achieve the projected targets.
Okay. CYIENT is the next one, and interestingly, you've chosen an IT stock. Why this one amongst all the others available?
Yeah, so if you will notice, we have chosen large cap stocks in many other sectors, and in IT we have gone for a mid cap stock because the large cap stocks, even at these prices, are attractive, but the risk reward or the potential upside may not be as large as a mid cap IT stock, especially CYIENT, because CYIENT at these prices is also quoting quite attractively at just I think 12.5 times FY20. So in that sense, and it is into niche engineering R&D space, having made some 6 acquisitions in the past 3 years, trying to give a complete suite to its customers in terms of the segments it is into. The order intake is also quite healthy, and I think at these valuations there may not be much downside surprises.
Okay. Lastly, ICICI Bank. Again, the same question. Why an ICICI Bank over an HDFC or a Kotak, or if you're taking corporate-facing banks, why not an Axis Bank?
Yeah, we like Axis Bank also. It has been our pick of the week, one of the pick of the weeks in the past 3 months or so. ICICI Bank, HDFC Bank, of course, we cannot recommend. We thought ICICI Bank is a good pick, mainly because all the recent problems that it has in terms of on the one side about the book, the NPAs, the slippages, the way the provisioning has been made. Now those seem to be coming to an end. Further slippages may be in control. On the other hand, the top management issues are also now resolved. The new managing director now has a focus towards portfolio quality and strengthening of the underwriting credit processes. Now, this will mean a prudent growth path for the bank. And compared to the other corporate-facing banks, I think this is available at a much cheaper valuation. People were keeping away from this bank as well as Axis Bank so far because of the NPA issues and also because of the top management issues. Now, both the issues having got resolved, I think one can take a bet that these two banks, especially ICICI Bank, will do well going forward.
Okay, Deepak Jasani, we'll leave it at that. Thank you so much for taking the time out and being with us today, and you and your team at HDFC. Well, happy festivities and a happy Diwali.